Okay. So welcome everybody. We'll start a traditional Q2 presentation, the same format as usually. We'll do Q&A very free by the end of the presentation when we show the backlogs for rest of the year. Quick summary of Q2. Very strong payment, like in Q1. Very big growth in e-commerce, especially in processing, also in independent networks, independent POS, and electronic cash registers. What you will notice is the share of EBIT and revenues generated from these independent networks and e-com, which is much higher value added, is growing dramatically, which we find a very good news for payment. Q2 was better than expected in banking because we expected a slight decline for the rest of the year. It seems this year for banking will be not declining but more flattish, and this is good news, compensated by some smaller deals happening here and there in change requests. Dedicated solution was hugely affected by write-offs, which we mentioned on previous conference we can expect in Q2. These write-offs will be described by Michał in the financial statements. But if we take away these write-offs, overall dedicated is still not satisfactory, but overall results are comparable to last year. We see an improvement also for dedicated solutions in the whole business in the backlog. By the end of the presentation, you see the backlogs, where it's a very big improvement in all business lines compared to end of Q1. Now, exchange rates, zloty became stronger against euro. So in numbers presented in zloty, this has a 7% hit on our currency. And last thing that we usually comment is transactionality, because in the payment business, we have a lot of transactional business. This is growing very quickly in e-commerce, in independent POSs, and also processing of physical card transactions. And you can see all these dynamics are excitingly high. So we are very happy from this, yes. Let's move on for the biggest deals. As for the biggest deals, they are never very, very sexy. One of big deals that happen in banking, a lot of changes around Basel III, about one core banking, which is not huge, but in Bosnia that we are doing a new one, origination for loan origination, this type of projects, instant payment integration, and some open banking API preparation for some banks. In dedicated solutions, not many, some live and TMS solutions, but also third-party solution, which is selling very well in Turkey. A lot of prolongations for the years ahead. I'll just remind you, it has a great cash flow effect, a recurring business effect. Unfortunately, usually it hits us negatively on the P&L because we take upfront payment in foreign currency in the beginning of a 3-year contract or 5-year contract, and then recognize it over time at a fixed exchange rate in Turkish lira. So inflation is eating up the positive effect of these deals during the recognition. But this we mentioned on previous conferences, and is described. In payment, in e-commerce processing, many deals in different domains, traditional payment gateway for banks, but also independent kind of financial institution in Turkey, offering more and more deals for merchants, as well as fintech suites for new startups. We offering a package for fintech startups to start business and give them all the tools to do this. As mentioned, business for merchants in form of payment gateway is also quite showing a lot of deals. Interesting for traditional card processing, we signed in Malta and in Croatia for processing of ATM acquiring. Interesting deals, and this is kind of new market entry for these markets. In traditional POS and ATM, bigger dynamics in ATM domain compared to POS. POS was slower in the first half of the year, and Q2 as well. ATM was quite dynamic, much more than last year. But we expect POS to catch up a bit in the second half of the year. Whereas for independent networks and ECR, quite good. Q3 is very important for them as well. But in-store payments is I would say booming, especially in Croatia, but also neighboring markets. Whereas in Romania, we are finishing integration with banks for offering the service for merchants to go more wide scale with this business, which we hope will start in Q3 and Q4 especially. And let's come to the numbers, Michał, please.
Welcome. As for numbers, first two columns are the total figures from our estimates. So it means including hyperinflation effect. As you see, 10.1 million euro EBIT versus 11.9 last year. Here we have the effect of hyperinflation plus 200,000 euro versus negative effect of minus 650 in previous year. Similar in net profit, 9.3, and this year pretty big positive effect of 1.4 million gains on hyperinflation, mainly related to revaluation of goodwill on Turkish entities. And then in following two columns, we have results without effect of hyperinflation, and all following comments will be giving about business units, countries, and now for whole group, we will be on numbers excluding this accounting effect. So on top line, we have growth 5% in euro, and this growth was generated mostly by own activities. Around 80% of this growth is from own activities, where we have growth primarily of SaaS and subscription based revenues, with a drop of implementation and modifications, mainly due to banking and dedication solutions. This drop. On operating profit level, 9.9 million euro. This result including one-off write-offs effect. To remind, it's 2.3 million euro, out of which 1.7 is reversal of revenues in dedicated solutions. This second part of this telco project, which we have written off previously in Q4. And additional, sorry, something is jumping, I don't know why. Additionally, we have write-off of assets, intangible assets in Romania for 500,000, also in dedicated solutions. So excluding those write-offs, result would be 12.2 million euro EBIT. So pretty close to the amount from previous year. When we look at numbers in Polish zloty, this drop is 25%, so 4 points more than euro, and this is related with drop of euro versus zloty exchange rate. And this year zloty is stronger. Below operating profit on net profit, we have 31% drop in euro figures, and here the biggest impact on this has financial activity. A result on financial activity is lower by 0.9 million euro, mainly due to two aspects. One is FX gains. Positive FX gains, which are lower than previous year. Last year, we had a bigger devaluation of Turkish lira versus dollar and euro, and this generated positive exchange rates. This year, this devaluation is we can say pretty low, and the gains generated on revaluation is significantly lower. On top of this, we have 300K of financial costs related with dividends paid to minority shareholders of those companies which are consolidated using present ownership method. To recall you, this method is that we consolidate in net profit full results, 100%, but on other hand, all dividends paid to minorities lands in financial costs of the group. As for taxes, they are pretty similar to last year. Effective tax rate is only by half percentage point higher than previous year. So let's look for results by business units. And here, first banking, as Piotr already mentioned, results are good, better than previously expected. Revenues almost the same as last year, and result exactly on the same level. So effectively, profitability also on the similar level. What is changed that last year, bigger part of result was generated by core banking related services and licenses, and this year this result was generated more on multi-channel solutions. Second business line, which is within ASEE, so dedicated solutions. Here we have increase of revenues by 1.2 million euro. After this write-off of 1.7, which I already mentioned, and this growth is mostly in third-party deliveries in Serbia, so third-party licenses and equipment. When we look at operating profit, dropped by 4.4 million euro. Out of this, 2.3 on related to one-offs, so excluding them, close to zero, slightly negative. And this is mainly due to drop of results in Romania, Serbia, and in lower extent in Poland and Croatia. And the last line, payment. As you already know, a strong one, 3.7 million euro growth of revenues and 1.7 of operating profit. And how it was generated. As you see, significant growth of revenues in e-commerce processing and independent networks, ECR and IPD. In total, they grew almost 5 million euro. We have also good quarter in ATMs in terms of revenues. And this is thanks to deliveries of new devices, mostly in Serbia and in lower values in Bosnia, Montenegro, and Bulgaria. For POS on revenues, this was weaker quarter by almost 5 million euro, mainly due to a strong basis. In Q3 23, we had huge deliveries of Android POS hardware to bank in Spain, and this is here revenues are lower by 5 million euro. But what is important and what we are very happy and proud of is that the share of e-commerce and processing and ECRs and the APD increased significantly. So as you see now, we have 63% share of those two lines in total EBIT of payment unit versus 43 in previous year, so 20% increase year over year. And let's move shortly to results by countries. So two countries with weak performance. One is Bosnia, 1.9 million euro lower results than previous year, but out of this 1.9, 1.7 is this reversal of revenues on telco project, which I mentioned. And second country with big drop is Romania, 1.2 million, out of which 500,000 is write-off of intangible assets, and rest is generated by dedicated solutions, dedicated solutions line. This drop. It was partially compensated, mainly thanks to Turkey, as you see, 1.2 million euro higher result generated mostly in payment by e-commerce, but also pretty good dedicated solutions, growing dedicated solutions. And other countries, they are pretty similar, so I will not comment. As for result for H1, Honestly, picture is pretty similar as for Q2. Revenues, again, I will concentrate on no hyperinflation figures, 5% increase year over year, but here fully on own activities. On third party, we have drop. Operating profit 21 million, including one-offs, what means 9% drop year over year, and in zloty 15%. So this is purely due to this stronger zloty versus euro this year. In coming quarters, assuming exchange rate will stay as it is currently, this effect should be lower and lower, because also in second half of last year, zloty already started to become stronger, and especially in Q4, the difference shouldn't be so big. Below operating profit, what we have, again, financial activity as main driver of bigger drop on net profit, 1.41 million euro lower financial result. Two reasons the same as in Q2, so FXs and dividends paid to minorities in Q2. On top of this, we have negative effect of revaluation of put and conditional considerations related with acquisitions, which generated 200K costs. So the value of liability increased. What's in general pretty normal, because we are reversing discount when this potential payment day is closed. And as for income tax and deferred tax, here excluding one-off in prior year, because we had this one-off tax related to earthquake in Q1 23. We have slight increase of effective tax rate by 1.3 percentage point on non-hyperinflation figures, and this is related with change of structure of result by country. Geography is more toward those with higher tax rate, plus the taxes related with dividends. For business units and segments, result by segments. Again, similar picture. Banking revenues higher than last year by 1.2 million, result by 0.4 million, with slightly higher profitability. The same comment about structure of business, less core solutions and more multi-channel solutions. In dedicated solutions, here we have drop under half-year figures of revenues, of course, including this one-offs. And this is related with the slow start of year, delay in contracting new projects. This is what we already mentioned after Q1. And payment very strong as in Q2. Already Piotr mentioned that the same trend in Q2 as Q1. So you can see this in results. It's very close to double of increases from Q2. And also by business lines in payment, very strong e-commerce and independent networks, also good ATMs and lower POSs, so same as in Q2. And a very similar picture about share of e-commerce and ECRs in EBIT, as 60% of EBIT was generated by those two lines with bigger value added for clients. And when we look at geographies, Bosnia and Romania we already know from Q2 figures, and this looks similar, but here additionally we have Serbia as declining one, and this is generated mostly by dedicated solutions. In Serbia, there were elections in first half of the year, delay in forming government. It was formed, but in last day when it could be, and this negatively affected contracting new project, because all projects in public, they were on hold until new government is formed. This was partially compensated again by Turkey, and thanks to e-commerce mostly, and in lower scale by dedicated solutions. So a few words about cash positions, cash flow, and liquidity. So as you can see on this slide, cash decreased by 20 million since end of the year. And there are four main reasons for this. One is we paid dividends. So usually ASEE paid dividend in July. This year we paid earlier in June, and it was almost 20 million euro what was distributed. Plus, on top of this, when we were collecting funds to holding company to pay dividends, we paid also dividends to minority shareholders, not controlling interest, in some subsidiaries of ASEE and Payten, and this outflow was around 1.6 million euro. This is one reason. Second reason are expenses on M&A. In first half of 2024, we spent around 10 million euros on M&As, not new M&As, but for earnouts related with transactions from 23, so Duet, Eastern Pay, and Avera, plus older earnout related with taking over non-controlling interest in ECR business 2 or 3 years ago. In total, around 10 million euro outflow. The third reason is investment in CapEx. But not this regular CapEx like office, cars, computers. This is pretty stable. No big difference versus previous year or first half of the year. But the difference is on project-related CapEx. This related with independent networks. When we build a network of our POSs, we need to buy them. And also related with independent network of ATMs and outsourcing of POSs and ATMs to banks. We have new project in Montenegro for outsourcing, but also we reach this phase in Serbia when we are renewing fleet of outsourced POSs to banks. And overall, those investments in this equipment for outsourcing year over year, they are around 3 million euro higher than in previous year. And the fourth reason for this drop in cash balance is operating cash flow. It was pretty weak in first half of the year, as you see, after adjusting for investment into terminals for outsourcing done through inventory. It's 2.4 million positive only versus 30 million last year. But this, and let's come back to previous slide, is related with working capital. As you see here at the bottom section of this slide, liabilities, they dropped by 29 million euro, and receivables only by 3 million euro. So we paid back a lot more of liabilities. And here two comments. One is that as you look at end of last year, this was pretty not typical situation. Our liabilities were significant, 11 million euro higher than the receivables. What is rather like one-off situation? Yes, usually we have higher receivables. So and this was related mostly with cases in Serbia and Romania, where our clients to utilize budgets, they paid to us advances, or they just paid invoices, but we haven't paid this to our vendors because it was related with dedicated solutions business and resell type of business. We closed those liabilities this year, and this is outflow. So in general, we believe that in next quarter this situation should reverse, and this gap between receivables and liabilities change should be lower, and effectively operating cash flow stronger than after first half of the year. So this is about cash position and cash flow. So let's move to outlook for this year.
Good. So as discussed, the backlog is much better than the numbers we have presented after Q1. Overall for the whole company and all the business lines, you can see for Q3 and Q2. For ASEE, so banking and dedicated solution, the backlog was negative compared to last year after Q1, -2%, -4%. Now it's positive, so we see this building up, and this is good news. We see slowly the deals in dedicated solutions popping up, and this is positive. In payment, it's even better. Yes, it was very positive, but also grew even more compared to last year. And this e-commerce transactional business, as well as traditional payment business, is growing. So we see the payment vertical is growing in its importance as expected, and also the e-commerce part, merchant part, is growing in importance, which is very good signal for the future. Having said that, we got some questions about the recent acquisition in India and Dubai we have made. So let me maybe give you a few explanations on this. Basically, in the stock exchange statement, we have given the maximum values that we might need to pay in case of the most optimistic scenario in terms of business growth. But everything is based on linear multiple of operating profit, and I cannot disclose much more details except for the fact that the valuations are at lower multiples than we are quoted as a company. Yes, and in the first part, for 51%, the earnouts are lower, and they are even lower for the remaining 49%. Yes, so it very much depends on the dynamics of profit, but the company would have to grow over next year significantly to reach the numbers mentioned in the statement. That's one point. What the company does: the company is pure payment company, both in Dubai and India, focusing on providing payment services for merchants. Basically, they used to have in India a payment institution license, which they lost because one of the key merchants had some Chinese origins, and this is a huge sensitivity in India. But now they are reapplying for the license, and they are also applying in Dubai for the merchant license. It doesn't mean they are not selling to merchants, but they have to use intermediaries for this. What does it mean? It means also not only giving up on small amount of commission to these intermediaries, but bigger and more serious merchants say, we will wait until you have a license, otherwise we don't want to work through intermediaries. So getting the license will dramatically increase the potential of revenue generation. It doesn't mean the company doesn't sell today. It does, and we estimate the company to do around 2 million profits on a yearly basis from the start for this year. They used to do more in the past. Now, before the license was dropped. Now, as for United Arab Emirates or Dubai, majority of the revenues are coming from white label or just classical sales of virtual POS or payment gateway to the banks and financial institutions, but the merchant part is very much growing, and this is the focus. And having said that, I would say that the outlook for the whole year is close to the analyst outlook. We confirm that we see the whole year on a level or at a level of last year plus, slightly positive, yes, on profit level. And the most glad or happy we are that we see the buildup of the backlog, not only for this year, but for the next year. So pretty positive on that side. And we are open to questions now. So please, you can either chat or you can speak out. I think we can, you're unmuted, all of you, so you can ask directly. If you have any questions, of course. Or observations. Good. I assume there's no questions. Everything is clear. If there would be anything you would like us to clarify, please contact me or Michał directly. We are more than happy, especially that this first half of the year in Q2 is not easy in comparison. Different things, write-offs, dividend last year paid in Q3, this year in Q2. Some recognition. So if anything, to have a better analysis like for like, we will be more than happy and open to clarify. If there's no questions, then we wish you a very good summer afternoon or day and good weekend ahead, and all the best. Thanks a lot. Thank you.
Thank you.